So we're going to be expecting an awful lot of volatility coming up in the next couple of days. We have massive announcements. We have the US, we have Germany, we have France, we have everyone coming up with their interest rate decisions. The PCE numbers are coming up. So we are going to see huge amounts of volatility. Guys, this is how you make sure that you protect yourself over the next couple of days. Now, we have seen a pump in the price of Bitcoin, as you can see here. And is it because everyone loves crypto? Is it just because the technicals or the fundamentals? Well, there's one reason why, and then I think there's also another reason why I don't think we're going to be able to hold this level for too long. Although we have actually been able to reclaim a really strong psychological level, because this is something that a lot of people look at, is the psychological levels that we see. Above that 20K, fantastic. Above 1,500 for Ethereum, absolutely fantastic. Now, obviously, I am kind of talking about Ethereum price raising and also Bitcoin, because the CFTC chairman, who's basically, and I'll get the acronym for you, Commodity Futures Trading Commission, this down here. So basically, the head has said, actually, Bitcoin and Ethereum are commodities, which means they come under different rules and regulations than the likes of stocks, which are considered securities. And so that has helped Ethereum and Bitcoin push to the upside, because no more Gary Gensler, you can't touch us anymore if Bitcoin and Ethereum are considered commodities, which also would massively help the whole XRP case as well. So bring that back up. I'm just being an idiot here. And so, we do see a little bit more of a continued rise in the XRP price here. But obviously, the stars of the show are Ethereum. Now, we have pulled back from those. What is it that we're currently looking at? And obviously, I'm talking primarily about the Fed here and what we're looking at on a wider bracket, not just on crypto. And I will do a video about this coming up soon, the CFTC. But for now, we're looking at stocks. Okay, we're looking at stocks, we're looking at the Fed, we're looking at European area, we're looking at everything. So stocks slip as traders assess earnings. This is another big area. So we are looking at the earnings. This is something that has a massive impact on the likes of crypto. And there's just not really any denying that. So here we are. Let's jump in a little bit further. Looking further down, there's not really too much to talk about. I do want to show you this. So this is the 10-year Treasury yield still climbing, which, as we know, is bad for the UK, crypto, bad for Bitcoin, bad for Ethereum. A little bit of a pull to the downside. As we know, there's been a nice little rally. With that earnings season has given us less of that, let's be defensive. And everyone is a little bit more frivolous with their money and throwing it into more risky assets, which is very good for us in the crypto space and also anyone who invests in tech. So just looking here, and there's a couple different reasons why we have had this change. So there's been a change from last week, a 95.6% chance of a 75 basis point hike. Okay, and this is from the Fed coming up early next week, so November the 2nd. We're going to see what is most likely at an 86% chance, a 75 basis point hike. But people are now calling for a 14% chance of a 50 basis point hike, when last week it was only 4. So let's just have a look as to what exactly it is that we're anticipating and why have we seen this reduction and I guess this optimism, because as we all know, we get a 50 basis point hike, everyone's happy, everyone's pumping. You get a 75, it's still that hawkish, like, hey guys, we still need to keep compressing the market. And I definitely think we will. Google have come out and said, hey, look, we're now going to start reducing the amount of employees we take on. So they're reducing their hiring, which is a good thing. It's exactly what everyone over at the Fed, and especially Jerome Powell, has really pushed for, is to see that squeeze on employment data. So we do have that to come out next week. But anyway, what are we looking at today? We're going to see in an hour and a half the Euro area coming out with their interest rate decision. Yesterday, we had the Bank of Canada come out. And there's also the GDP growth rate for the US at 4:30 local time, so wherever that is, but basically in an hour and 45 minutes. So you can work it out yourself. And then also there's the press conference from the Euro area. So they'll come out and they'll be like, Christine Lagarde will probably say, hey, things are not going too well, but we are going to be quite aggressive in our rate hikes moving forward. So we think inflation is going to be under control at some point in the near future. But what's interesting though is that the Bank of Canada, they increased their policy interest rates by only 50 basis points. And I think that's partly what's kind of stirring on this here. So even you saw from yesterday, we went from an 11.5 or 11.2% chance up to a 14% chance, just based upon one day. And that's as a result of Bank of Canada saying, look, we're going to be a little bit more dovish. Obviously, if the US do this, like I said, it's going to be very positive for stocks and essentially every risk asset. So we have seen a bit of a perfect combination. Key support levels. We've also seen the CFTC chairman come out, and that's also helped push the price of major cryptos up, which is nice. But is this the full story? And it's worth noting the Bank of Canada are still continuing their quantitative tightening, which is basically, they buy loads of stuff and then that pumps loads of money into the market. They're buying bonds, they're buying mortgage-backed securities, the same as what the Fed have done. But then the Fed ended up with a $9 trillion balance sheet. So what they need to do is reduce that and reduce the amount of debt that they hold. And essentially that in itself will be, instead of printing money and buying stuff, buying all this bad debt, they'll then be selling some of this off or just letting it expire. So there's going to be less money in the economy, which is exactly what they want. Now, next week, I think we might get a new summary of economic projections, but we are still working on the same old rate, federal funds rate of 4.4. This hasn't been updated. And so, when we look at this to the next month, Fed fund rate, or, the next month's hike, we could be looking, and most likely is going to be, if we have a 4% hike, we have a hike up to 4%, we will then have a hike up to only 4.5, which will end us from 4.25 to 4.5 in this region here of the federal fund rate as they pretty much want, which is, it's okay. It's not so bad. It's baked into the market, I think, is the main thing. It's not like there's going to be any nasty surprises and everyone's going to be like, it's already anticipated. But it is worth noting that we see here a little bit of changes in the percentages. Obviously, some outliers are a little bit more likely now to have only a very small basis point hike, 25, which if we have that, I mean, I don't know. I don't think that it will happen, and I think it might be a bit too early to take their foot off the gas. Also, because we want to buy more cheap Bitcoin, so that's what we want. But having a reduction, sorry, in the chance of a basis point hike of 50 up to now only 51% chance of having a 50 basis point hike. So moving further on, looking at the overall spectrum, what is Jerome Powell going to be doing? And this is, I think, one of the key indicators that we're going to see when we come to this rate hike decision, is that we're looking at something that is called an inversion. Okay, and this is not the typical inversion of the 10-year and the 2-year yield. The 10-year yield on a treasury bill or a US bond typically tells us what's going to be the landscape, what's going to be the inflation rate, etc., 10 years down the line, okay, because you buy it and it expires in 10 years. But then also you can buy a bond and it expires in 3 years. So now what we have seen, interestingly, is that the US Treasury bond market is increasingly flashing recession risk as the yield on the 3-month T-bill tops that of the 10-year Treasury bill a number of times since Tuesday in a move known as yield curve inversion, which I mentioned earlier. The on and off 3-month, 10-year, that's bloody difficult, isn't it? Inversions, which signals investors' expectations for a grim economic downturn, comes ahead of the Federal Reserve's November monetary policy meeting, which again is going to happen. Monetary policy meeting, notes that first and second, and then, on the second, this is where we're going to have the decision. Whoops. Just watch that look up there. Comes ahead of the Fed Reserve monetary policy meeting, where it's largely anticipated to raise the benchmark interest by 75 basis point hike for a 4th straight time to bring inflation down. That would bring the rate between 3.75 and we've basically gone through this. But this is one thing that I think the Fed, now that we're looking at the 3-month yield going through this inversion, it kind of shows us that there does need to be a lot of caution in the markets, and over the next 3 months, we are going to see an awful lot of pain. And I think that will massively, I'm going to say, like, increase the risk of having a recession. But, we've been in a recession for, 6 months now, not even 6 months, no, but, you have two consecutive quarters of negative growth, and that's a recession. That's already happened, but they changed oh, it's not actually. So we got, going through this, so we're seeing the Fed rate increases work its way through the economy. Citi predicts that the domestic economy will be pushed into a recession by the second half of 2023. So guys, we're not looking at a massive 100k Bitcoin by the end of February or January. Once we start having that kind of, the yield curve, not the yield curve, the rate hikes will begin to kind of stagnate, and they might not go up for a very long time. In fact, they're pretty much anticipated to stay stable. But the whole point of raising these rate hikes at the moment, everyone's panicking about the future. But the issues are not really here, not yet anyway. And so everyone's like, oh, I'm so worried. But, once we get to that stage and we're at, let's say, like a 4% or 4.5% Fed fund rate, we're going to stay there for a whole year. So, with actually even a very slight increase in the early stage of next year, but we're still going to be at those high levels. So it's still going to cost everyone a lot of money to get a mortgage. No one's going to be borrowing money, and so we're still going to have a very, very slow economy. And so finding different assets within the, I guess, the financial landscape is going to be quite tough. One, I would say banks are going to be a really, really good, I guess, good investment. Not financial advice, but obviously they charge you a lot of money to borrow. And so when people are going to be borrowing because they have to buy a mortgage or they have to borrow money to start a business, they're going to be paying an extreme amount. So obviously the banks are going to be making tons. So we are going to see this, and this is something to kind of have a look at further on. Just want to quickly mention Jerome Powell again. He's facing political pressures as worries mount over the economy, because he has two choices, guys. So he can either, take his foot off the gas and do a 75 basis point and then maybe like a 25 basis point when it comes to December. But that's not squashing inflation, which we can't forget is the main reason why we're going through all of this in the first place. So if he does start to like take his foot off the gas, you can be very certain that all of the politicians would be like, hey mate, we put you in this chair and we need inflation to come down. So you have to do your job and make sure inflation comes down. So quantitative tightening will probably still stick around. And so, yeah, even unemployment hasn't really come down that much. So we are seeing that to be an issue. And I mentioned Google earlier, so I'm just going to come back onto these. Like I said, so Alphabet reported, which is the parent company of Google, Alphabet reported disappointing earnings on Tuesday. Revenue growth slowed down, way down from 41% last year to just 6% this year. That is a massive slowdown. Now, I think the mood for the reports has generally been positive for earnings reports, which is not necessarily a good thing. Why are companies still growing when the Fed are trying to squeeze the economy and basically shrink it? Said Alex, a managing director at Wolf Research. Now, one other point that I do want to mention, the jobs market is in good shape, so no surprise that payroll processor ADP beat earnings, and this is an issue. So, like it says here, yeah, ADP reported higher earnings on Wednesday. That surprised investors. Why are people, getting new software to handle more employees when unemployment is supposed to be going up? So we're not at the inversion process yet. We're not quite there where we see unemployment really coming down substantially. We're not quite there where earnings are being smashed. Yes, Google, obviously, earnings, they're still making a profit, and they're growing, but just not as much. Even Meta, so Mark Zuckerberg's Meta, he said he seeks patience as costs spook investors. Because we are going to see, guys, wherever a big tech company, how do they make most of their money? They provide you free services, but they get it through advertising. This is one of the first things. People are not going to be advertising on Snapchat, Facebook, Google, all of these different platforms as the recession really sets in. And so are you going to borrow money at a crazy high rate just so you can advertise? Probably not. So we are going to see the tech sector overall, the NASDAQ 100, for example, begin to feel a lot more pain. And so as this happens, combined with the fact that we have the US dollar being so strong, so not making as many sales internationally, it's going to really slow down the NASDAQ, which makes me worry about the likes of Bitcoin, because we do know there's a correlation between the Nasdaq and Bitcoin and just pretty much every crypto asset itself. So this is a worry for me. I don't think that just because we've got above these psychological levels that everything is plain sailing. You know, we have had great pumps, but we were always going to get squeezed in one direction or the other, you know, and we all knew low volatility, technical levels were getting very, very close to being broken, and we needed to have some kind of pump. The volume, luckily, went to the upside, which is very good. But unfortunately, I don't think it's going to stick around. But anyway, that's just my humble opinion. If you get any questions, drop them in the comments below, and I will see you in the next video. Thank you very much for watching. Let me know if you agree.